Tech ETFs like Nvidia pays dividend every Friday? A few years ago, that would have sounded ridiculous. Today, it's possible. Last week, we built the safest weekly paycheck possible using Treasury ETFs. That was your foundation, the sleep well at night part of your portfolio. But let's be honest. Most of you didn't open brokerage accounts to own T-bills. You're here for the engines of the global economy. You own Nvidia, you own Apple, you own Microsoft, or at least you want to. Here's the tension every modern investor faces. These companies are growing at breakneck speeds, leading the AI revolution. But as income plays, they are almost useless. Apple pays less than 1%. Nvidia is effectively zero. They reinvest their billions into R&D and chip fabrication, not into your bank account. So you're left with a choice. Do you want the growth or do you want the income? In the old days of investing, you had to choose. You either bought growth and waited 20 years to sell, or you bought value stocks like Coca-Cola and waited for a 3% dividend check. But what if I told you that in 2026, the game has changed? What if you could own the AI gold rush and still get a notification every single Friday that cash has been deposited into your account? Today, we are diving into the world of income overlays. We're looking at QDTE, XDTE, NVDY, and AMZY. These are the weekly income machines of the tech world. But a word of warning, there is a hidden tax on these funds. By the end of this video, you will know exactly what you're giving up in exchange for that weekly cash flow.
To understand these ETFs, you have to stop thinking like a stock picker and start thinking like a landlord. Now, stick with me here. In the real world, if you own a house, you have two ways to make money. The house value goes up, that's appreciation, or you rent it out, that's income. Tech stocks like Nvidia usually only give you appreciation, but these ETFs turn that stock into a rental property. Let's use NVDY, the Yield Max Nvidia Option Income Strategy ETF, as our example, which is one of the tickers we will be discussing. NVDY doesn't just buy Nvidia stock and sit on it. Instead, NVDY uses what we call a synthetic covered call strategy. Now, don't let the word synthetic scare you. It just means the fund doesn't necessarily hold millions of shares outright. Instead, it uses options, specifically long calls and short puts, to mimic the price movement of Nvidia. Why does it do that? Because it frees up capital, and that leads to step 2, the harvest. Instead of waiting for Nvidia to pay a dividend, which it barely does, the fund sells call options against that synthetic position. And when you sell a call option, someone pays you for it. Think of it as rent. In the options market, the buyer pays a premium for the right to potentially buy the stock at a specific price. That premium is cash. NVDY collects that rent and distributes it to you. Now here's the critical part. Since NVDY launched in 2023, Nvidia has had weeks where it surged 10%, 15%, even 20%. In those weeks, NVDY did not capture all of that growth. Why? Because when you sell a call option, you are agreeing to sell the stock at a predetermined price, the strike price. If Nvidia explodes past that strike price, the option buyer captures the excess upside. You keep the premium, they keep the moonshot. So what are you really doing here? You are trading uncapped growth for immediate cash flow. In a strong bull market, you will underperform Nvidia. In a flat market or even a slightly down market, you may outperform because the rent keeps coming in.
Ticker number 1, QDTE. Roundhill Innovation 100 Zero DTE Covered Call ETF. Let's start with this. Launched in March 2024, QDTE was the first ETF built around selling daily zero DTE options on NASDAQ 100 exposure. Instead of selling monthly calls like older covered call funds, QDTE sells options that expire the same day they're written. That daily decay is the engine. It allows the fund to harvest premium 5 days a week and pay you every Friday. What's inside? QDTE builds synthetic exposure to the NASDAQ 100 and holds cash and short-term treasuries as collateral. Then it sells daily call options against that exposure. Now let's talk about the headline number. In 2026, QDTE has shown an annualized yield hovering around the 40–50% range, depending on volatility. That sounds incredible. But remember, this yield fluctuates. It rises when volatility rises. It compresses when markets calm down. Expense ratio? 0.97%. You are paying nearly 1% for daily option management. And here's the trade-off. In a roaring bull market, QDTE will underperform QQQ. In a sideways or choppy market, it can outperform because the rent keeps coming in. This is not growth maximization. This is volatility monetization.
Now, let's move to XDTE, Roundhill S&P 500 0 DTE Covered Call ETF. If QDTE is the tech-heavy income engine, XDTE is its more conservative sister. It launched at the same time, March 2024, and uses the exact same daily 0 DTE option framework. The difference is what it sits on top of. Instead of innovation-heavy NASDAQ exposure, XDTE builds synthetic exposure to the S&P 500. That means Apple and Microsoft are still there, but so are healthcare giants, financial institutions, consumer staples, industrials, the whole broad market mix. In other words, this is built for the investor who wants weekly income, but doesn't want their financial life tied entirely to tech volatility. Structurally, it works the same way as QDTE. Synthetic long exposure to the S&P 500, cash and short-term treasuries held as collateral, daily call options sold against that exposure, weekly distributions funded by option premiums. Because the S&P 500 is generally less volatile than the NASDAQ 100, option premiums tend to be smaller. Smaller premiums mean lower yield, but it also usually means price swings are less dramatic. Now, let's look at the numbers. As of 2026, XDTE has displayed an annualized dividend yield around the mid-30% range, roughly 35% to 36% depending on volatility. Again, that number is not fixed. It moves with market conditions. Expense ratio, 0.97%, same as QDTE. And the payout schedule, every Friday. Now, here's the honest comparison. If markets go on a strong, clean bull run, XDTE will likely underperform SPY. You are selling upside to create income. But in sideways or choppy markets, XDTE can hold up surprisingly well because the daily premium collection acts like steady rent. Think of it this way. QDTE is higher octane income from innovation volatility. XDTE is steadier income from broad market volatility. Both are income overlays. Neither is a pure growth strategy.
Ticker number 3, NVDY. YieldMax NVDA Option Income Strategy ETF. Now we move into concentrated territory. NVDY launched in May 2023, right as NVIDIA was becoming the centerpiece of the AI boom. It quickly became the poster child of the YieldMax lineup. Why? Because NVIDIA is one of the most volatile mega-cap stocks in the world, and volatility is fuel for option income. But this is the first thing you need to understand. NVDY is a single stock ETF. It is not diversified. Its fate is tied almost entirely to one company, NVIDIA. If NVIDIA has a great year, NVDY benefits. If NVIDIA has a brutal year, NVDY feels it immediately. Now let's talk about structure. Like the other YieldMax funds, NVDY does not simply hold shares and wait. It typically builds synthetic long exposure to NVIDIA using options. It holds short-term US Treasury securities as collateral. Then it aggressively sells call options against that exposure. Those call premiums are collected and distributed. Because NVIDIA's volatility is high, sometimes extreme, option premiums can be very rich. That's how you end up seeing eye-catching numbers. As of 2026, NVDY has displayed an annualized dividend yield hovering near 70 to 80%, depending on market conditions. Let's pause there. That number is staggering, But it does not mean you are earning 80% total return. It means the income generated from option premiums, annualized, is extremely high. And this is the trade-off. When Nvidia surges 15 or 20% in a short period, NVDY does not capture all of that upside. It sold away part of it through call options. And because distributions are large, the share price can experience structural pressure over time, what we call NAV erosion. If Nvidia stalls or declines, the fund still declines. The income may cushion it, but it does not eliminate downside. Expense ratio? 1.27%. That is meaningfully higher than QDTE or XDTE. You are paying for concentrated, active, high-frequency option management. And the payout? Weekly. But this is not a core holding. This is a tactical instrument. Think of NVDY like a high-performance passive income engine. It produces enormous income, but it requires discipline in position sizing, because when you concentrate on one volatile stock and cap the upside, you are fundamentally changing your return profile.
Let's finish with AMZ, YieldMax Amazon Option Income Strategy ETF. AMZ launched in July 2023 as part of the early wave of YieldMax single stock income funds. Instead of targeting Nvidia's extreme volatility, AMZ focuses on Amazon, the retail and cloud computing giant that sits at the center of global e-commerce and enterprise infrastructure. Now, here's an important distinction. Amazon is volatile, but it's not Nvidia-level volatile. That matters because volatility drives option premiums, and option premiums drive income. Structurally, AMZ works the same way as NVDY. It builds synthetic exposure to Amazon using options, it holds short-term US Treasury bills as collateral, and it sells call options against that exposure to generate premium income. Those premiums are aggregated and paid out weekly. But because Amazon's stock movement tends to be more measured than a high beta semiconductor name, the income profile is typically lower than NVDY. As of 2026, AMZ has displayed an annualized dividend yield in the low 40% range, roughly 40%. Again, that number moves with volatility. If Amazon becomes more volatile, income rises. If volatility compresses, income falls. Expense ratio? 1.17%. Lower than NVDY, but still meaningfully higher than QDTE or XDTE. You're paying for an active single stock option strategy. Now, here's the trade-off. Amazon doesn't tend to have the same explosive short-term surges as Nvidia, so in some environments, the opportunity cost of capped upside may feel less dramatic, but the structure is the same. It's a tactical overlay. Think of it this way. QDTE and XDTE are diversified volatility engines. NVDY and AMZ are concentrated volatility engines.
Before you run out and buy any of these, we need one serious conversation. First, NAV erosion, what I call the leaking bucket problem. If a fund shows a 50% yield, but the underlying stock only grows 10%, that extra income doesn't come from nowhere. Sometimes it's coming from selling upside aggressively, sometimes it's coming from return of capital, and sometimes it's coming from the share price gradually declining. Here's the math. You invest $20,000. You collect $10,000 in distributions, but the share price falls, and your remaining shares are now worth $12,000. That's $22,000 total. That's a 10% total return, not 50%. Yield is not total return. These are income tools, not compounding machines. Now layer in taxes. Most of these payouts are not qualified dividends. They're typically taxed as ordinary income or short-term gains, your regular tax rate. And in some years, a large portion may be classified as return of capital. ROC isn't taxed today, but it lowers your cost basis, which means a larger capital gains bill later. So here's the smart move. If you can, hold these in a Roth or tax-advantaged account, and always calculate your after-tax yield, not the headline number, because what matters isn't what the screen says, it's what you actually keep.
As an investor, I care about systems, not trends, not hype, but pure systems. So here's the real wealth hack framework. Tier 1 is your foundation. That's your Treasury weekly funds from Part 1.
WEEK, MMKT, and the other low-stress tickers we covered from my video last week. For many investors, 40 and above, this could represent the majority of your portfolio, 50%, 60%, sometimes even more, depending on your risk tolerance. This is the part that pays the rent. It's not flashy. Tier 2 is the engine. That's QDTE and XDTE. This is where you convert market volatility into weekly income while still maintaining broad equity exposure. For many investors, this might be 20–30% of a balanced portfolio. It gives you growth participation, but with cash flow attached. Then there's Tier 3, the turbo. That's NVDY or AMZY. Single stock, higher volatility, higher structural risk. This is not core money. This is 5 to 10% money. This is the income you might use for travel, lifestyle upgrades, or reinvesting back into your foundation. If you're 25, 30, even 35, your most powerful asset is time. You may be better off owning growth ETFs like VGT, SMH, or SCHG directly and letting compounding do the heavy lifting. But if you're 45 to 65 plus, your priorities shift. You start caring more about income consistency, reducing sequence of return risk, turning volatility into cash instead of waiting 20 years to sell. That's where these strategies shine. The tech-driven weekly paycheck isn't magic, it's a trade-off. You are exchanging explosive upside for immediate, predictable cash flow. But we're not done, because what if I told you there's a tier beyond this, a place where 70%, 80%, even 100% yields show up on the screen? In Part 3, we step into the danger zone, crypto-linked income funds, although I do not like crypto much because it's extremely volatile. And we're going to answer one question: is a 100% yield a